Joining us right now is Barry Sternlicht. He is the chairman and CEO of Starwood Capital and the chairman of Starwood Property Trust, which is the largest commercial mortgage REIT in the United States. Barry, it's good to see you. It's been a while since we've talked about these things. You have been opposed to the Fed raising for quite some time because of the damage you think it's doing. What do you think about these latest comments from Jay Powell?
Thanks. Good morning, guys. You know, I haven't been opposed to the raise in rates. I mean, it was just late, and the pace of the raise was what I was opposed to. I was very pleased that he paused.
Yeah.
But, you know, we're mutual golf fans, you know, and there's Jim Nantz says this was a weekend like no other. This is an economic recession like no other. Well, nobody's ever seen anything like this. This doesn't make any sense what's happening. You have the fastest contraction in M2 in history, and you're looking for signs of the economy slowing down. And why is it not slowing down? So I really tried to. My thesis in college was I had a statement. There are lies, damn lies, and then there are statistics. So I think you have to boil down. I listen to all these economists. I'm not an economist, but I come on the show, and I want to go a little deeper on the data and show you what's actually happening because it's fascinating. So let's start with the employment market, if we can.
We have some charts that we're going to show as we go through this. So why don't we call up the first one?
So the employment market, I think we had like 339,000 jobs in May. And I kind of said this in the last appearance a little while ago, that in the 07-08 recession, two industries, healthcare and education, actually gained jobs. And you can see last month, it was the leading category of growth, almost 100,000 jobs. In the last 12 months, that's been 1 million jobs. So healthcare and education is not sensitive to interest rates. Nobody is not getting sick because he's going to take short rates to 6. So he can't impact that. Go 2 columns more, government. That actually is local government. And that's been almost 500,000 jobs in the last 12 months. That's should reverse. What governments are doing is catching up. It's basically municipalities and states. It's not the federal government, actually. And so he can't really impact that. The last category is probably one of the most important to me, the leisure and hospitality. That's been 850,000 jobs in 12 months. And last month, it was the fourth highest category. That is hotels and also restaurants. Mm-hmm. And you know we have no workers. Like, we still have no workers. And we had 1.5 million workers in 2019. We had 1 million last year. So every month we're gaining 50, 60, 70. It's average 77,000 jobs a month in that category alone. That's going to fill. We still have a backlog of 350,000 empty jobs. Right. So you're going to see he's got a sort of a tidal wave coming at him. If you kept that chart up, manufacturing finally went negative last month. It's the last category. And we took out like 17 categories: financial activities, utilities, information, retail trade, wholesale trade, which are basically flat. So everything else is flat, and this is the total gain. And he's trying to kill a labor force with interest rates that's hard structurally to kill with just interest rates.
We can come back off the chart now, but I think that's the reason that we have not seen the job market slow. It's been so stubborn.
And he's measuring his success. He wants to increase or lower employment. But he doesn't want to, but I
think he thinks that's the only way that you can actually get to a point where you slow wage growth down and therefore slow inflation.
So let's talk about the other problem, which I said I'm sorry for his situation, but he has the federal government spending out of control. So look at spending, which is called discretionary spending. Yeah. So many people might not realize that we're spending more money this year than we did the last 2 pandemic years. And Joe would like this, right?
I would like it.
Well, you'd like to not
like
do
to complain about it. Right.
We'd like some fiscal discipline.
Right, I'd like to complain.
But it's so amusing that they have a discussion of huge argument about the debt ceiling when they're spending. They agreed to spend $1.7 trillion. And that is actually just up about $100 billion in defense over those 4 years. The rest of it is other stuff. So you have the federal government, which is the largest. Who spends $1.7 trillion? Not even Tesla. So $1.7 trillion is not changing with interest rates. Right. The government doesn't say,
3.5 Twitters.
Yeah, let's go pull back on spending. This is committed spending. And I think and you see the construction number was up last month. I was like, wow. But that's probably federal spending on construction projects and data centers. There's now a website you can go to where you can see where they're spending the $1 trillion of infrastructure money. So you've got the federal government with their foot to the floor, accelerator, and the Treasury trying to break it. It doesn't feel like a real economy. Now, he says the economy is so strong. Look at retail sales. Look at advanced retail sales. We have a slide for that. So retail sales are falling off a cliff.
The argument, though, has been that people are spending their money on services instead of
and that's true, but that should slow, right? I think they'll slow. We're beginning to see a topping out in the hotel market. Like
But Barry,
like prices are not going up.
You came on, I went back to look.
Yeah.
September 15th, 2022, we wrote a headline. The U.S. economy is breaking hard.
It is breaking hard.
Says Starwood, Barry Sternlicht.
I was a little early.
Okay.
I didn't understand the strength of the consumer. I mean, I did not. I think people are employed. And people are employed, they spend money. And they're not feeling like they're at risk of their job. So I think today you see a stronger economy, but there are signs of weakness. But there are, they're spending on services.
Could you still be early, is the question.
Well, I think, like, you saw credit cards now. There were record credit card numbers. B of A just said that we've reached the same levels of delinquencies. I think we're headed higher. And look at the last slide, which is inflation, which I come on and talk about all the time. It's such a bizarre number, which is the rent growth. It's a third of CPI and 42% of his PCE. This is the biggest flaw in his inflation data. He knows it. He's talked about the lag. But the blue line is basically what's happened to rents. And the green, the top one, the green, that's going down. And the green line is what the Fed's reporting. In last month's number, this number went up. Housing equivalent went up from 0.4 to 0.6. It's an anomaly. It was actually a really weird thing that happened with hotels.
Who came on and who talked about if you stripped it out, if you stripped out that component of it, you would have seen
we're going to see inflation lower than 3%. And the question is he going to be happy with that? I mean, I know he says 2%. I hear every morning about credibility. They have credibility, for Jesus Christ. That's why I say that. They have credibility. I mean, everyone knows. And who are the victims of the Fed raising rates? Like, who's really suffering? The federal government is a $32 trillion deficit. We're the biggest. We have to pay the interest on $32 trillion at higher rates. That number right now is like $660 billion. 5% on $32 trillion is $1.6 trillion. Right? We're going to have to keep printing money just to pay the interest expense. Second category, regional banks. You guys have said things are not fine in the regional banks. He can say it all he wants, but the government is basically giving you an implied guarantee on deposits. So there's been no run on the rest of the banks. The banks are not in good shape, the regional banks. They all have commercial real estate loans. We can mark the securities to market.
No, and Janet Yellen has said that she'd be interested in having some of them pair up, having them be bought, having capitalization.
Look, only by the grace of God do some of these regional banks continue to walk. Basically, any group of hedge funds can take one of them down any moment because they can't create liquidity and they can't sell their bonds at market. They crystallize these losses. And we can't even look at their commercial real estate loans. We can't figure out how close they are. But you know that the victims of these rate increases are all fixed assets, bonds, real estate, infrastructure. Anything that was a yield is worth less.